Hi everyone, it's Alex here at SesStream Capital Research. Welcome to our Growth Investor Pro weekly webinar. It's currently Thursday, the 26th of June, just after 4:15 Eastern for the benefit of the tape. Today, I want to cover our standard market review and spend a little bit of time on that. My best guess, and it's only a guess and only an opinion, is we are approaching a local market high. Now, obviously, we're also approaching in the S&P an all-time high. We're not far off it. But it looks to me like we will see some, I suspect, short-term correction in the next few days. And I'm not suggesting for a moment that's any sort of collapse or ginormous dump or anything like that, but I think we're going to see a little bit of weakness after the tremendous bull run we've had in recent days. So I want to walk through the logic for that. We'll look at the VIX, look at the 10-year yield and the TLT bond ETF, and then as our usual risk indicators, we're going to look at the semiconductor sector and Bitcoin. Single stock requests, the one that came in, ones that came in today, Fortinet, TTD, which Hermit is going to present. Hermit is the master of picks at the moment. He's coming up with some tremendous swing trades. TTD is one of the latest ones, so he's going to talk us through that. We'll look at NVIDIA, ASML, Taiwan Semiconductor, and Palantir. And as always, we run these things on a live open mic basis. So once we've done our disclaimer in a moment, we'll switch mics on. Any questions, points, comments, anything at all that you have, please do pile it. If you can't use audio or you don't care to, then please do use the question or the comment functions here in the webinar platform. I can see the questions pop up and read them out. As always, these things are great to the extent that we have lots of people participating. As you know, I can talk about stocks all day long, every single day, weekdays, weekends, and all night too if you let me, and that's great. But these things are more valuable to the extent we have more people joining in, more questions, comments, agreements, disagreements, doesn't matter. It's the debate that leads us all to be able to do better at our investing and trading work. So please do pipe up if you have questions or comments or anything at all. All right, so let's get on. We'll do our disclaimer, which is on your screen right now. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at or intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. SesStream Capital Research, its employees, agents, or affiliates may be made for position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of SesStream Capital Research. SesStream Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's switch microphones on. Okay, so mics are all on now. Back to our agenda, and let's get going. And as always, we're going to start with our long-term S&P chart. It's boring, it's dull, but it's really important. Let's get this on your screen right now. Okay, so this is a monthly chart. And as you know, if you've been with us for a while, we've been using the same chart for some years now. It's proven pretty useful. And we started at the COVID lows back here. We're now in, I think, a wave 3 up from this starting point down here in March, April 2020. I think we probably have a wave 3 high still to come. And if that's true, then probably a wave 4 down, which could be pretty painful, and then a final 5th wave higher for the final bull act of this cycle that began 5 years ago, I think. Let's look at where we are now. As I've said every week, it's really, really important to try to internalize this because it does away with fear. If you ignore the weird intraday movement during April, which of course was fear-driven, and the fear was, as always, stoked so that other people could buy up cheap shares, then we have a pretty normal market that moves up from the 2022 lows, and it climbs the stairs and it takes a few steps back and then up again, a step back and up again and a step back. If you just ignore that long tail, I know that's a sort of silly thing to say in some ways, but it's not. If you're a long-term investor, you look at the screen every day, and you went on vacation in April and you came back and you go, how much happened this month? Whereas if you're staring at the screen all day and you're not prepared and dialed in and have your ice cold methodologies with you, it's really easy to get freaked out in April. And a lot of people did, and a lot of people left the market. And that includes plenty of institutions and hedge funds who ought to know better. And part of the reason you're seeing such a aggressive rally to the upside right now is a lot of people looking stupid because they bailed in April. And if you're an individual investor, if you've made a mistake, it's no big deal. It's yourself to whom you're accountable. So all you have to do is correct the mistake. So if you're pointing in the wrong direction, it's fine. Just turn around and point in the correct direction. All that requires is confidence and not being wedded to a thesis, but reacting to the market in front of you. Once we train ourselves, we can all do that. Institutions, though, it's harder for them to do that. First of all, decisions are rarely made, large capital decisions are rarely made by a single individual. So if the fund is positioned incorrectly, it takes a little while to turn that particular ship around. And then each quarter end dates are really important in markets. Each quarter, the funds have to make an account of themselves against their chosen benchmark. So, not all funds mark themselves against the S&P, but plenty do. Plenty long funds mark themselves against the S&P. So if the S&P and the NASDAQ are in a major rally up off of these April lows, and you missed it because you sat it out in April because you were scared, well, you've got a problem because you're going to underperform in Q2. And if you underperform in Q2, your investors, your clients, if you're providing advisory services, are going to be unhappy. So what are you going to do? You are going to absolutely pile in towards the end of Q2. You're going to over-allocate to equities, over-allocate to the NASDAQ, over-allocate to the S&P, over-allocate to the big stocks. You can see it in semiconductor as well, so that come June 30, you don't look an idiot. What you can then say to your clients, to your limited partners, is you can say, well, look, we got April a bit wrong, but that's okay. We caught up. Sure, we're a bit behind, but that's okay. We'll catch up for the rest of the year in H2. That's your message, filled with suitably calming noises and an expensive dinner or two, and some encouraging noises about the future is what you would do, and that's fine. But that's what's driving the rally at the moment. It's a need to not underperform the index at quarter two end, which is just a few days away. You will also see, as a result, plenty. If you look beneath the surface and you look into the options market, you will see plenty of hedging activity taking place. And you will see that hedging activity to protect against a possible sell-off at the beginning of the third quarter, which, if memory serves me right, starts on, I'm going to say Tuesday, but certainly early next week. And so quarter ends tend to bring somewhat extreme moves, whether they're on the downside or the upside. We also have some options expirations happening, but mainly this is a quarter end valuation rush. So it could be that markets just keep dashing to the upside. That definitely could be. But I think it's more likely that we see probably a continued run up to June 30. So that's another couple of trading days. And then I suspect some short-term weakness early part of Q3. And by weakness, I mean, a standard sort of sell-off, a December type sell-off, at worst, probably a March type sell-off. I don't mean an April type dump. So that's my opinion, just my opinion. And so that's the opinion that pervades my own trading decisions. So personally, I'm very net long, but I've been winding on some hedges in semiconductor and the NASDAQ. I have some index puts for September expiry. So overall, when the market goes up each day, that's great. I'm doing well, it's going up, but I'm not going up as fast as the market right now because I'm winding on some hedges. That's okay because I've piled in long at the April lows. And so my acceleration during the second half of April, May and June has been faster than market, so I don't mind slowing up a bit now. If I'm wrong, if July just keeps going up, then I need to change direction. I need to abandon my opinion, my thesis, release those hedges and just ride the upside. And that's how we all, that's about the level of energy and worry that we should all be putting into this, which is just remain calm, try to point in the right direction. If wrong, change course. Let's look at the short-term S&P, because all of the major equity charts look pretty much the same at the moment. I posted in chat today, there's a no paywall market review article on our website today. So take a look at that. You'll see these charts in there, and you'll see a sort of longer form written out version of the logic here. This is the SPY ETF. It's a daily chart. And I appreciate it's a bit of a mess, but let me walk you through it. And this is why I think we're going to see some weakness in early Q3. This ignores the option market. We don't deal with that in these charts. But just look at the price and the volume action. Okay, so here's the April low, bounces hard, rips up, puts in a 61.8 retrace. In other words, it drops about 62% of the value that was created in the 1, 2, 3 days between April the 7th and April 9. Now, in the world of technical analysis, 61.8 retrace is a pretty good signal that says you're going to reverse to the upside, sort of lingua franca, that is a universal code amongst market participants that says if it holds there, probably it's going to move up. And it did. So we got this, what I think is a wave 3 high here, fairly shallow wave 3, a 1.236 extension. Often a wave 3 will go to 1.618, which is what we're approaching now. So I have this as a 5th wave ending around now, but it could be this is actually just the 3rd wave ending. It doesn't change my logic of a coming sell-off, but if that's a 5th wave, we'll get a deeper sell-off, and if it's a 3rd wave, we'll get a sharper sell-off, basically. But for now, let's say that's a wave 3 high. And one of the reasons I think it's a wave 3 high is if we look at some of the momentum indicators. So this is the MACD down here. It peaks around here. And although price moves higher into this, what I think is a 5th wave right now, momentum is declining. So not a big one for trading according to the MACD or RSI or any of these indicators, because all they are really is just a different way to look at price. They're just a lens on price. But what they're telling you is the intensity of price acceleration was higher here than it is here. Another way to look at that is look at the angle of attack for price. The angle of attack is really steep in this wave 3. It's fairly shallow in this wave 5. And look also at the volume. Okay, so this light blue box here, this defines the volume by price analysis. So time here starts April the 7th, and it ends here today. And what this tells you is what's the volume traded at each price level within this blue box. And this is the whole move from the April lows. What does it tell you? There's a big concentration of volume up here. Now, let's think what that is. Of course, anything that's sold is also bought. So sometimes you'll see people say, well, that's buying, or that's selling. And of course, if it's sold, it's bought. What I tend to think of as this is, who's leading here? Who's providing the impetus? Is this, because what you want to know is what is it that institutions are doing? Institutions are the price setters. Momentum hedge funds don't set price, they react. Independent investors, retail, don't set price, they react. Large institutional asset managers set price. So what are they doing here? Are they buying? Well, they might be for the reasons I've just said, which is they might have missed out. They might have sold on the way down here and missed out here. So that could be led by institutions buying. But if it is, I would expect that they are also hedging that out so that in the event of weakness in the 3rd quarter, this won't punish them too much. But I rather suspect that this is distribution. In other words, I rather suspect that this is big money selling to small money. Small money is starting to print its year-to-date performance all over Twitter, always a contra indicator. Everyone's all hyped up about, the usual stocks. I think things are ripe for reversal. And if that's true, this is smart money who are buying down here or who just held all the way through the sell-off, taking some profits into quarter end. Whenever you see price action like this, big volume up at local highs, it's usually distribution. Not always. Sometimes it's late accumulation getting ready for another leg up. So you can't be certain, but it's usually distribution. The same way, if you saw big volume down here at the lows, you go, that's probably buy. In general, assume that price setting investors are pretty good at their job. So assume they tend to concentrate the buys at the lows and concentrate the sells at the highs. Might not be correct, but it's a reasonable assumption. If you look at the NASDAQ, which as you know has made new highs, we have a pretty similar short-term chart, slightly more bullish actually, but the very same story. So one up, two down, another 61.8 retrace there, exactly the same as the S&P, a wave three up, a bigger wave three. As you'll always find in the NASDAQ that the amplitude of the waves, the moves, the price amplitude is always bigger than the S&P, more volatile. Wave four down and a fifth wave up. And again, look, the volume more concentrated up here. You've got declining momentum. So momentum was higher at the wave three high than it is here, even though price is higher. The one very bullish thing in the NASDAQ is so-called golden cross. So this light blue line here is the 50-day moving average, and the darker blue line here is the 200-day moving average. And just as a rule of thumb, nothing other than that, and again, it's just a different lens on price, this says, well, look, if the 50-day crosses up and over the 200 from below, that's a bullish sign, right? That means that the short-term price action is dragging up the averages, and of course, the shorter moving average moves faster. And so that's generally a bullish signal. That doesn't mean it's only going to go up. What I think it means is if we do get a sell-off, I think the absolute floor of a sell-off personally will be the 200-day moving average, which is around 500 right now. So, that's not much of a drop. Let's say we get what people will be squealing about being a brutal sell-off in July. I don't think the NASDAQ's going to drop more than 10%. It might do, but I don't think so. And it might hold up and over the 50-day, which right now is at 505. So I think that this bullish cross here is to be respected, even in the event of a sell-off. Right? I think that is a bullish signal, whichever way you look at it. And so even if we do see some weakness, that is a big indicator saying, no, medium term, we're good. Things are going to keep going up. That's my analysis anyway. Let's look at the Dow briefly. So the Dow did make a new local high today. And you can see it's just the same chart with all these things. So here's move up off the April lows, a deeper wave two low in the Dow. It's unusual. So almost a 78.6 retrace, a 1.236 extension, wave four down. Look, the 50-day holds. So it's thinking about breaking the 50-day again on the 23rd of May, but it holds up over the 200, breaks back down below the 200 and up. Three daily closes now above the 200. So again, declining momentum. Momentum was higher at the wave three high than it is right now, even though price is higher now. We don't have a golden cross. The 50 has not crossed over the 200, and we don't have it in the S&P either. So the NASDAQ is ahead of everything. So again, if we get a sell-off, I don't think we're getting a big, run for the hills. I think we'll get a correction. And in the Dow, again, maybe the 200-day holds. I suspect not. I think it will give way, but I suspect the 50-day will hold. So I would look at any sell-off opportunity here. My own personal view is if it does correct, I don't think the indices are going to drop more than 10%. I really don't. And so more likely 3, 4, 5% corrections, something like that would be my guess. Let's look at what the VIX is doing. The VIX is really informative as well. Now the VIX, you've heard me say this often. Let me just get rid of the moving averages. They're not helpful, and that's irrelevant, and that's irrelevant, and that's irrelevant. Okay, I say the same old thing that I always say, but first of all, what is the VIX index? Okay, it's an index. It's not a tradable security, and it's an index of, in effect, demand for S&P 500 puts greater than 30 days to expiry. Okay, so in other words, it is a measure of people buying portfolio insurance more than a month that expires more than a month out. When the VIX spikes, it's because people are panicking and they're protecting their portfolios when their portfolios are already sold off. This is like your house has burned down and now you go and buy fire and life, right? Whereas obviously the sensible thing to do is when you've just built your house and it's all spick and span and it hasn't burned down, go and buy some insurance. This is obvious, right? It's obvious to anybody in daily life, but a lot of people lose their heads in securities markets, which of course is how securities markets are designed to operate. So the VIX is a really good opposite day sort of indicator. It has spikes every now and then. It sometimes has these enormous spikes, like the yen carry trade spike August last year, or the tariff spike in April this year. But as you can see from its history, those things are relatively rare. This is the COVID crisis here. This was right here, a big fight between the White House and the Fed here. And I can't remember what this one was now. They normally don't spike this much, but you get these things up to I'm going to say 25 on the index, 30 reasonably often. And if you watch the VIX, it's a useful way to try and work out your risk management. If the VIX is on the floor, it means that people have become complacent. It means that people think the market's going to go up forever. They don't want to buy puts because puts are just a drag. And it's a good time when the VIX is low to think about some sort of portfolio protection. There's lots of ways of doing that, inverse ETFs, take some profits and increase your cash balances, buy some puts, and the VIX won't help you with zero DTE or short dated puts, but it is a good guide for longer dated put protection. And so personally, I think yesterday or the day before, I bought just a small quantity of at the money S&P, SPY and QQQ puts for September expiry. Why September? Because that gives me time. Options will burn you if you're wrong and they're short dated, but if you can be wrong and long dated, you have more chance of making money from them. I just started to wind on some of those. And I'm not a big options trader, but I find that buying some protective puts when the VIX is at the lows with enough time for some protection tends to work out quite well. It's not life-changing money, but just helps to cushion the blow when the market sells off a bit. VIX can drop much further. Okay, so just because we are at a recent low of around 16, which has held, in March this year, May, early June, there's no reason it can't drop. Your longer term support is right down here at 11. So a VIX of 16 does not mean the market's about to crash. What it means is, the VIX is falling, volatility is falling, and therefore investors are becoming complacent. So this isn't any sort of mechanical, go and short the market. That's not what this is. This is you might think about buying some protection. That's what this is useful for. Next, let's look at 10-year yield. And the reason this is important is because this prices US government debt effectively. Specifically, the yield at which US government bonds are trading, 10-year bonds are trading, it sort of sets the price at which any new bond issuance is issued. Not perfectly, but this is a sort of a reference point for it. And so it's a good thing for the US government if the yield is falling, because it can issue new debt at a better price with a lower coupon. In other words, lower interest payments. So as you can imagine, it's really important to this administration to try and get this yield down. And you'll see some policy moves that are geared at doing that. Two things happened this week. Number one, tier one bank capital constraints were released a little bit. And so the administration, as of, I would say yesterday, has basically said to the large banks, the money center banks, they can hold more US treasuries within their core capital. So that means that banks will start buying treasuries, and so that should be to the benefit of the yield, meaning the yield should fall. The impact of that, it's not dramatic. It's not like a big round of QE, but it is material. And it doesn't surprise me that the yield dropped a point to then. If we look at TLT, which is the 20 plus year bond ETF, again, this is the longer term chart. So we're still down here at the lows. And again, look at the volume profile, right? So this can only have been since August 23, so about 2 years in now. Okay, all the volumes down here. So is this institution selling? I don't think so. I think this is buy. I know that some foreign investors don't want to hold US bonds and all that, but I think this is institutional accumulation buy. If we look at the short-term chart on TLT, it's looking quite good. So here's the lows, 22nd of May, got a 1 up, a 2 down, holds at the 50% retracement. We're currently in a wave 3 up. And the earliest I would expect that to terminate is around 88, which would be the 100% extension of that wave 1 placed that wave 2. It could go higher, but that's the earliest I would expect it to terminate. And then if we see a sell-off then, I would expect it to hold around this 86 level here. I'm pretty bullish on TLT. I've said for a long time, I think that bonds are going to get a day in the sun. I think that the yield is going to come down. I think we're going to see some capital come into bonds. People will be getting underweight US bonds at the moment, and that will mean revert at some point, I suspect. It's also a really good hedge to own some of this stuff against any economic problems. So there are a number now of sensible economic commentators. I don't mean hysterical doom dwellers. I mean sensible folks who are saying there are some stored up problems in the economy. They're not happening right now, but the problems are stored up in consumer confidence, consumer credit, those sorts of things. And next year goes this logic, we're going to see some problems in the real economy, and that might feed through to some problems in equities. Well, if that's true, then we'll probably see some rotation from equities to bonds. And if that's true, that should benefit TLT. TLT is not the world's most exciting holding, but does pay a 4% dividend or thereabouts. And I personally think it has a solid future. I own a pretty decent allocation of this thing and have done for some time now. Lastly, before we stop and take some questions, let's do Bitcoin and semiconductor as risk indicators. So Bitcoin is making, it's obviously in good shape, but it's making a series of lower highs from about a month ago, right? So it's in a sort of a downtrend. Just look at the moving averages. It's recovered some of its ground the last, so we've had 1, 2, 3, again, 4 daily closes over the 50-day. Okay, so that's probably short term, but look, it is in this downtrend here, and I don't think Bitcoin is done. I think it's got plenty to go, but you don't have huge price momentum in Bitcoin right now, so we'll see. If we get a market sell-off, Bitcoin will sell off. I would expect faster than equities. Again, I mean, I'd be very surprised if the 200-day broke. It did not break over last weekend when everyone was all pretending to be worried about Israel, Iran, and all of that, and it held well over the 200-day. So I think if there is a short-term correction, it should probably do the same. Lastly, semiconductor, which has been absolutely on fire, incredible. So this is SOXX. This is the move up from the April lows. 1 up, a 2 down, drops to between the 61.8 and the 78.6. Here's your wave 3 up, almost a 1.618. Here's a wave 4, and here's a wave 5. And again, if we look at the momentum, you will see that it's the same chart, almost the same chart as the indices, but stronger actually. So can you say, you can just about say that momentum is weaker here now than at the wave 3 high, just about. But it's a harder argument for the indices. Semiconductor has been incredibly strong. Now, this will sell off at some point, of course it will. So if you're long semiconductor, think about taking some profits or hedging or something like that. This is an incredible run, and I think it can continue. If you look, we've not had the golden cross yet in semiconductor SOXX. 50 days not yet crossed the 200. It has in the Nasdaq. It hasn't in the S&P. It hasn't in the Dow. It has in Bitcoin, and it hasn't in semiconductor. I think we're still in a bull market, so I think this will happen. So I think there is plenty of upside ahead for semiconductor, but near term, this will at some point correct. So it's been a huge run. If you long this or long semiconductor stocks, just be ready for a bit of weakness if it comes along. Okay, I'm going to stop before we're doing any of our single stock stuff, and I'll take questions. So who's up? Prasad, welcome, you're on.
Hi, Alex. So question on you mentioned about institutions not having allocations and they're just trying to do a catch up, right? So if they're trying to do a catch up, then who do you expect the distribution to come from in July? Do you think like if they're just getting into position now, they would want to hold on and see some returns on the position before they exit out, right? So what's what prompts you to think like July will be a minor sell-off?
The smart move, if you're moving really big money, okay, because remember, if you're moving large amounts of capital, you can induce other market participants to act against their own interests simply by your actions. So let's say I had a really enormous amount of capital. And let's say I've been late to the party and I've got myself a bit scared in April. I know that if I pile money into the NASDAQ and the chip stocks and whatnot, I know that I can create some euphoria because I know that the press will get all excited, that Twitter will be all full of, to the moon and all that. And I know that I can induce buying fever. So I know that I can put capital to work. Other people are going to pile in and bid me up. This is what we call our markup zone, right? Which is stuff you've already bought. It's going to be marked up for free. Now, a smart move is also right now to be buying puts, and the VIX doesn't show shorter dated puts, right? So what I can't show you here is any options market analysis. But a smart move says, okay, I'm Mr. Institution. I'm going to put big money to work in the Nasdaq. Let's say big money in the S&P, big money in semiconductor. Same time, I'm going to be buying some puts. Now, look, puts are cheap, right? They're cheap because the VIX is on the floor, implied volatility is low, premium is cheap. So I'm going to buy me some puts. And then what I'm going to do is I will probably again, if I was trying to cause the market to move by my own actions, and after the end of Q2, because remember I get judged by my investors and my clients, and my own personal bonus is judged every quarter. I'm not judged so much day to day. A momentum fund might be, a hedge fund might be, a pod in a fund might be, but a big asset manager, it's a quarter end measure. So I've got a whole quarter to play some games before anyone looks at my performance again. So I come to the June 30, I report against the index, all good. And better, I can say to my investors, look, not only are we, approximately tracking the index, okay, we've underperformed a bit in April, but we caught up. Not only did I do that, but also I've got some protection. So, if we see some weakness in the third quarter, I'm going to say to my investors, don't worry, we've got you back. Then what I would do is on July 1, 2, 3, 4, I'd go and dump rapidly as much of these high price stocks as I could. Why? For two reasons. One, because I get to cash some gains, which is always good. And then two, because the puts I already own will go up massively in value because implied volatility will be rising. So IV goes up, value of the puts goes up. So by my own actions, one, I cash out the gains I've got in stocks, and two, by selling stocks, I drive up the implied volatility in the market. So the puts I own on those stocks or on indices or futures options or whatever it might be, those downside protection instruments, they go up in value mechanically. And then what I do when everybody's all scared and all over the press, it's market in turmoil and was it all just a dream and there's a double top in the S&P and blah recession and all that, right? Then I go, whoopee, now I'll sell the puts, and together with all the money I cashed in from selling my stock at the end of Q2, now I'm going to buy. And that is the game you play if you're a skilled institutional manager. You can only play that game if you have enough money that actually moves the markets, right? But that is what I would do if I had a wall of money. That's what I would do. You just drag the market around and you freak everyone out all day long, right? Just when everyone thinks the bull is here for good, you go bang, sell, right? Bang. And your puts are rising in value. You know the world isn't going to end because you know it's only selling because you're selling and your buddies are selling. Okay. Once the puts are up in value, sell the puts and use the gains on your puts, which will be big percentages, and use the cash you realize at the end of Q2 to buy again at local lows, and off we go again. That's what I would do.
Got makes sense, makes sense. So, you're suggesting like September 30th expiry? Is that what you're buying?
I am not an options expert, and I would not in a million years take what I do in options as any sort of wonderful idea. This is my logic, okay? It's not very complicated. Options scare the hell out of me because they can go to zero. And if you buy short-dated options, they have a tendency to go to zero quite quickly. So I obviously don't want that to happen. So my logic goes like this. Number one, I want the options I buy to be liquid. In other words, I want there to be lots of open interest. When is there lots of open interest? Well, there's usually lots of open interest on quarterly expiration dates. And you can go to the CBOE website and you can find out when the quarterly expiration dates are, because all institutions will buy options and dealers will buy and sell options for quarterly expiration. Okay, so that gives me my strike. I don't want, we're through Q2 OPEX, so June expiration is already gone. There are monthlies, but that's one that's not very long, and two, monthly expiries have lower open interest usually. So September gives me enough time. Next, I tend to buy puts when the VIX is really low, and I tend to buy at the money strikes, okay? Which means if SPY is at 610, I'll buy a 610 strike if there is one, put for September quarterly expiry date. And I'll buy in fairly small allocations, right? I'm not putting big allocations into this because, again, options can go to zero. And if I'm wrong and the market moves, well, I'm going to lose all my money, which is not all that attractive. Whereas with an ETF or a stock, it might go up or down, but it's hard to lose all your money. Not so for options, it's really easy to lose all your money.
So when you say small, sorry to interrupt. So when you say small, right, like when you have 100 units of capital already invested into stocks that are long, are you buying 1 unit of put protection?
Yeah,
Or
so I have I can't remember how many units I've got deployed in total at the moment, but it's I own 2 units of puts at the moment. One of SPY at the money puts when they were bought the other day for September expiring, and one unit of QQQ. And I might add another 1 unit of each maybe. After that, I'm looking at that amount of capital and thinking, well, if that goes to zero, that's not great. So if you're buying SPY, it might fall, but it's not going to go to zero. But if you're buying options, it could go to zero. And so you have to, in my mind anyway, you have to allocate capital to your options with the notion that you might lose all that money. And therefore, yeah, in my mind, and I'm not an options trader, you have to say, okay, can I deal with it if I lose all that money? Okay, all of it. If no, then I've got too much money in them. If yes, that's okay. That's how I approach it. Now, that is a pretty risk-averse way to use options, I can tell you. And I would not follow my options trades because I'm making it up as I go along, right? I am not a trained options trader. We run an option service, Jay's Options, on our website, and Jay is a superb options trader and much better than me. But that's my method to just give myself some downside protection when I think the market's going to fall. And generally, I do okay with that. I also, by the way, tend to sell them too early. So if I'm up 20, 30% on options like that, I'm out, right? That's fine. That's good for me. Other people are braver and will hold them and they'll double or treble them if you're lucky. I mean, I did this, I think, for March expiry this year. And had I actually held them to expiry, I would have been dancing a very big jig. But I didn't. I sold them early, and so I'm not the world's best options trader, but it's another tool in the toolkit for me.
makes sense, makes sense. So One follow-up question on this, like if institutions are the ones that are price setters and their demand sets the price, right? Like then if they're buying put options so much, why are the price so low?
Doesn't show because the VIX is only showing you greater than 30 days expiry. Okay, so it's not showing any shorter dated options. So if they're buying puts, um, a week or two out, that's not going to show up. And I don't have the analysis to show that. I don't cover it. Don't cover that market.
Got it, got it. Okay. Sounds good.
Right,
Okay.
great. Hassan, great question. Thank you. We've got to move on. Thanks a lot. Jose, you're on. Jose, we can't hear you. Okay, well, let's keep going. If Jose comes on, we'll.
Yeah, I'm here. I'm here.
Oh, hey, how you doing? Go ahead.
Yeah. The question was about those the horizontal bars. I don't know what they
Yeah,
are called. A profile, something, volume
yeah,
profile. I
yeah.
noticed that they're all in gray, and I've seen some versions where they show you green and red to indicate what volume was lifting the price and what volume was reducing the price. Do you see any value in that?
I don't personally because I don't think because what we all want, okay, from that volume analysis, everybody wants is show me who's buying and who's selling, right? That's what we all want. We all want to know, is it idiots buying or is it idiots selling? That's what we all want to know. But you can't get that data easily. I mean, you have to people dedicate, banks of computing power to this, where you try to break down every single trade and you look at was it struck at the bid or the ask or what, and kind of reassemble blocks of trades to work out that was a sweep, or people put a lot of work into it, and you can't tell that. And so when you ask the chart providers, what does that mean? Green or red on the volume, they'll just tell you, well, that was during an up day or an up hour or whatever it was, not during a down hour. So I've never found any use to it. So I just set these to grey because it is a pretty coarse tool, and it requires a lot of interpretation. And that's even with just grey bars telling you that it's just volume.
Yeah.
Because the other thing you could say, for instance, is you could say, well, look, of course the volume is higher up here because look, it's been in this price zone for a longer period of time. So of course volume's higher. That doesn't tell you anything. You can argue. You could say that's just more time has elapsed. So even if that's just people busily trading as opposed to accumulating or distributing, this is not a meaningful indicator. You could argue, and there's some force to that argument. So I try to use that volume overlay as a sort of an additional piece in the fact pattern. I think you can get bent out of shape on assigning
Yeah.
too much meaning to it. Is my take.
Okay. Okay. Thank you.
What I do is I look at a chart like that and I go, okay, look, I've got what I think is a 5-wave high. I think it because of the Fibonacci extensions. I've got general euphoria on social media. I've got declining momentum, and I've also got a lot of volume up here. And so my analysis goes, look, what's likely to happen next? Is it likely that it rockets up? Is it likely that it trends sideways, or is it likely that it corrects? That's my approach. And so to me, of course, we can all be completely flat wrong. My analysis goes, I think that's likely to see a bit of weakness next. I don't think we're going to get a market crash. Why? Well, because we just had one, right? So usually you don't get another one right after, the February to April crash. They don't come along that often, and that was a pretty brutal one. Crashed through the 200. Took a while to get up and over it. This is the Nasdaq, S&P are the same. We just had a pretty brutal crash. Probably not going to get another one. And also in the Nasdaq, this golden cross here, that is meaningful. That is a bullish indicator. So my analysis goes, I've got some bearish stuff piling up here, but I don't think this is a dump coming. I think it's a short-term correction. And so, personally, what do I do about that? I tend to wind on hedges of various kinds. So personally, I use the inverse ETFs, some puts here and there. And, it's never done perfectly. I've been a little bit early on some of the inverse ETFs, so they're a bit out of the money. That's okay. Deal with that. I've still got the long side, so I'm still going up as the market rises. And what I do is go, okay, if we get a correction, then I know that I've got to be pretty quick to get out of the hedges, because I don't think we're getting a dump. I don't think, this is the big one, it's all going to blow. I think we're going to run down to somewhere down here. So if I saw the QQQ getting to sort of, 520 or something, I think, that'll do me, I'm out, And, I won't call it all the way down. It'll probably sell off lower, but then I've made some money on the way down. I can reinvest that profit on the long side and run it up again. That's my method. It's not perfect, but it works okay.
Okay. Thank you.
Question, Jose. Thank you. Right, let's move on and do some single stock stuff. So what have we got? We said that we would look at, let's do Fortinet first, and let's do TTD. And I'm going to ask Richard to pile in on TTD. Right, so Fortinet. Fortinet, as you know, security business, still sells some boxes, makes a lot of money from services as well. Here we have it. So it started a move up, I think, at the October 23. And we think what we have here is a 1 up, a 2 down, held at the 61.8, a 200% wave 3 up, an ABC correction down into the April or March lows, actually. Okay, didn't get hurt too badly in April. It's interesting. And then we think this is making a move up to what's probably a cycle high up here somewhere. So we have this accumulate rated. If the market does sell off, Fortinet will get hit, of course. But again, it's already put in a big correction here from what was an all-time high of 114, split adjusted, down to 81. And so I would expect that if it corrects, it'll probably hold over this stop zone, maybe fall into it a little bit before another move up. So Fortinet, all of cybersecurity right now is doing pretty well. It's proven pretty robust. It's a well-run business, not the most exciting cybersecurity business, but for that reason, it's a reliable, trusted vendor for many large enterprises. So the chart looks pretty good. Fundamentals also solid. It's a pretty cautiously run business. They do a lot of stock buybacks. Pretty high margin business. Very, very solid balance sheet. If we look shorter term, what does this tell us? This is what we think is happening shorter term. So here is this is this large degree wave 4 low here, on shorter degree 1 up here, 2 down, 3 up, 4, and it looks like it's holding over its own 50-day here. So we've had 1, 2, 3, 4 daily closes over the 50-day moving average. We now have an upward sloping 200, and you can see the importance of these 200-day moving averages. It dropped a little bit below that back in April, but not much. And you can also see the importance of the 50-day, so it shoots up over it. Okay, here's a little bit breakdown. That'll be earnings probably back up above, and it's held the 50-day quite well since the 12th of May. So I think that Fortinet, I think there's an enormous upside here. I wouldn't pile into this personally, but I suspect it can probably do okay. So that's that. TTD, Richard, if you're on, do you want to try and join by asking a question, and we'll patch you in?
Yep, I'm here.
Oh, hey, how you doing? Great. So I get TTD on the screen now. So Hermit Warrior here has put in a blinding performance on a number of the swing trade picks recently, much braver than me, and I salute his work, done fantastically well. And this week called TTD as a possible long trade. So Richard, do you want to talk it through, and I'll fly the charts. You tell me what you want to see.
Sure, thanks, Alex. So you might recall that we had TTD as a pick earlier as it was progressing through the current kind of new 5-way pattern. So that would have been the wave 1 after having gone down very significantly, as you can see from the chart. So we rode that successfully. We sold a little early, but that's okay. And then really the strategy was to wait for the wave 2 and then hopefully the beginning of the wave 3. So that seemed to be the case certainly earlier this week. And so, I called it as a beginning of a wave 3. So, the expectation would then be we're now going to be able to ride that wave 3 pretty significantly higher. But obviously, being quite cautious because wave 3s are not terminating at the usual point as we've seen in the past. So we've got a target of around that 1.236 extension perhaps, which would still be significantly higher than it is today, around a 60% gain. Of note, you might notice there on the chart the volume spikes at the accumulate zone there, but also volume spikes at the current price, which I think is again indicative of perhaps accumulation loading up before the stock moves higher. Interestingly enough, I've moved that time clock to be at the beginning of the kind of main, or rather the intermediate kind of wave 1 to 5. You can't see that on this chart here, but a little bit further kind of away from like the April 22nd, April 22 kind of time frame. And the volume profile is very similar to the volume profile if we take it to the very top of the kind of performance at the 140 level. So we see the same spikes no matter where we have the volume spike. So I thought that was quite interesting as well.
Hey, just talk me through that again. Where do you want time equals 0 on this?
So time equals 0, if you put that at the very height of the price, so around that, what is it, October 24? Yeah. So if you look at that,
yeah.
So there's the spike in the current price area,
yeah,
as well as the accumulation zone when it was all beaten up. But if you put that volume clock to, let's say, April 2022, the volume profile looks very similar. And for me, obviously, the clincher is the volume profile at the kind of the most recent timing shows.
Yeah. Yep. Okay, so this is a new pick, and what will happen is this: again, if we get a market sell-off, TTD will drop, and so it's never possible to call these picks perfectly. Obviously, we've done pretty well. If you look at the closed picks, very well actually. Some of them just go into the red and never recover. We've not had too many of those, but sometimes it happens. This one, if the market drops, this will sell off. But if we're right and it's a correction rather than a real market reversal and a move to a bear market, then it should catch a bid. And you could think about, well, if it sells off, let's say you bought it today at 68, and then the market sells off into July, where's it going to bottom out? Good chance it bottoms out around 57, which is the 61.8 retrace of the move up from the April lows. If not, maybe 51. And you can see it's a volatile stock. So what we try to do with these picks is we try to say, well, look, obviously there are going to be times when the market just goes against us, and for with all the best intentions in the world, we just call it wrong. But we try to pick stocks that are never going to dump catastrophically, where even if they get a bit beaten up by the market, they should recover. And TTD is definitely in that camp. So, we'll see how it goes. Anything can happen, but we think there's a good chance there's some gains to be had on that. A word on the pick system, by the way, which is like all these things in our service, they're not intended to be commandments. It's not a model portfolio. It's nothing like that. They are basically they're swing trade ideas where we think there is an opportunity to buy into a rock solid company at a local low or an attractive entry point, hold for a few weeks, maybe a few months, and then exit with good solid gains. And we're usually looking to score somewhere between 10 and 20 points on a return. Sometimes we get the opportunity to go higher, and sometimes very high. So if we were buying right in the depths of a market correction, as we did with some of these at the end of 22, then there's 300, 400, 500, 700% returns. In some cases, clearly we're not going to do that very often. And so we're looking for swing trade opportunities. That's what those picks are. And again, we'll get plenty wrong, of course, but so far, if you look at the closed picks, then on balance, pretty good. So that's how to think of the picks. Of course, you'll use your own judgment as to whether they're things you want to own in your own work, and if so, in what allocation. You know that better than us. We're not trying to tell you what to do with your money. That these are just ideas that we hope you find useful in your own work. I will say again, Hermit's done a fantastic job on these lately. They're all his work of late, not mine, and he's very modest about it, but had some tremendous wins with ARM twice, I think, Marvell, TTD once already, and his current ones on are TTD and XLV, the healthcare ETF. So best luck with those, Richard. Okay, thank you. Let's move on and let's look at NVIDIA, ASML, Taiwan Semiconductor, and Palantir, and then we'll finish on those. So let's go. Okay, so here's ARM. Being a semiconductor stock, it's completely on fire at the moment. And it's probably due to cool off. So here's the cycle low in April at 79. And it's now pretty much doubled. So, that if you were to look at the valuation multiples, I don't have them to hand, but if you were to look at them, it would be pretty much off the chart right now. So I would expect that to cool off sooner rather than later. I would also expect it to keep running up after a correction, but it's probably due to top out, will be my guess. ASML I saw was down today, and maybe portends the start of a correction in semiconductor. Maybe. So let's have a look. So this is ASML. Okay, that's interesting. So that's local high. Golden cross today, actually. So 50 up and over the 200. Okay, that's a bullish sign. But like all these things, if you look, what we have is we have declining momentum for higher price. So better technicians than me will call that momentum divergence, meaning price is rising but momentum is declining. So there's a good chance that was a local high in ASML. Now again, if it corrects, what's going to hold? I'd be very surprised if the 200 broke. That's at 725 right now. And on the assumption that the 50 keeps moving up a little bit, my guess is the 50-day will hold. So again, I don't, even if we get some weakness, of course we may not, it might just keep running up to the end of the year, no one knows. Or some people do know, but they're not going to tell us. If it sells off, then I would look for, again, not more than a 10% sell-off. That would be my guess. TSM, Taiwan Semiconductor, again, pretty much on fire, I would think. Yeah. So again, 200-day right at the 50-day coming up right at the 200 today. Again, wouldn't surprise me to see that as a sort of a trigger for a slowdown, really. I think everything in semiconductor right now, I mean, it's hard to pile in and buy chip sector stocks right now just because they've run up so much. Doesn't mean they're not going to keep going up. It does mean that, at least for me, I'd be waiting for them to take a breather. In semiconductors, I am long SOXL, which is the 3 times levered long ETF, and I'm long SOXS, the short. And I personally have been banking some gains on SOXL on the way up, just because I piled into it in the April lows to good effect. But it gave me a very overweight position in SOXL in my trading account, and you don't want a massive position in it because it's so volatile. So I've been taking some profits on SOXL on the way up. We don't cover it in the service, but if you remember right, in a circle service, you'd have seen the trade alerts on that. So I'm sort of balanced and ready for a sell-off in semiconductor. I would hope my currently underwater SOX hedge would become less underwater or potentially in profit, and it will cushion the blow of any sell-off, but we'll see. Lastly, Palantir.
Sorry, Alex, just a quick question on that TSM chart.
Yeah.
So why would that not be a continuing wave 3?
Yeah, it might be.
That wave 4 is really shallow, just
Yeah,
looking at the
yeah,
candles.
yeah. No, it's all these charts. It could be. Let's draw that out. What would that look like? Because all these charts where I've got a 5, it definitely could be a 3 in these things. So let's look. Let's start again from scratch. So yeah, so you could say, no. There's your wave 2, right? And there's your 3.
It's almost like that dip towards the end there could be the wave
Could be the
4
4.
potential.
Yeah.
At least
Yeah,
it's
exactly.
a bigger dip.
Yeah,
with
and
the-
also, let's just sketch this out. Yeah, good point. Also, 1, 2. So it could be that, right? 3 up there, and then we get a 4. Who knows where? And a 5. Could be that. Or, to your point, that's peak momentum for now. There, right? There. Actually there. And then that could be a very shallow 4. And it could be that's a 5. Why? Because price is higher but momentum is lower. Pretty close run thing. So yeah, it's a good point, Richard. Very good point. And also that there is spot on a 2.618 high. So that's a good. Yeah, you're right. It's a good candidate for a wave 3. Absolutely right. Yeah. Okay, I think we'll go with that actually. Let's call that a current wave 5 high. Yeah, good point. Yeah, so let's go with that for now. Yeah, good point. But again, could you pile in and buy time and semiconductor? I mean, you could, and you might be lucky. I wouldn't personally. I would sort of wait to see if we get any short-term corrections. Thanks, Richard. That's great. I think you're probably right on that. Right, Palantir. What is to say about Palantir? It's going to keep going up because it's absolutely embedded within the government. They're going to find more and more contracts for it. So I think it's got plenty of upside to go. And the question is, when do you buy it? I mean, what it's rewarded so far since the new administration has come in is buy dips. There's always dips. Any stock, doesn't matter how excitable, there's always dips. What does this reward? Whenever there's a big one, buy it. And so if Palantir is a stock that you want to own, you don't already, that was my strategy, which is even when you think it's only going to go up, it isn't. No stock does that. So if you see a meaningful dip and you want to own it, consider buying some. Don't pile all of your allocation into it on day one because there's always going to be another dip. And I would think that certainly for the life of this administration, it's going to keep going up. That would be my guess. I don't own it. I sold out way too early, and this isn't my sort of stock to get back into. But if you've held this one throughout, then many congratulations. And I suspect there's more upside ahead. So that's my take on Palantir. Where might this cycle end? If this is right, then that's a wave 3. It looks like it is with that peak in momentum. Wave 4 down here holds over the 200. Then it kind of should, in inverted commas, terminate somewhere between this 61.8 wave 5 extension at 131 and 170. So if you said that it could be in a sort of a topping zone now, definitely. But if it ran on for some reason, maybe 170 is probably a local high, and then probably a meaningful correction and opportunity to get in lower. That would be my guess. Again, I don't own Palantir. I'm not planning to. Okay, well, we're over time, folks, so we better finish up. Thank you, everyone, for joining. Great questions, as always. Richard, thanks very much for those great picks and also for the alternative commentary on Taiwan Semiconductor. This is what I would say, folks, which is the value of these webinars is I can talk all day about stocks, but what's most interesting is to try to get to better answers together. And so, if you see something on these sessions and you think, I don't agree with that, I think it's this, please do pile it. There's no ego to this. We're all trying to make more money, and we can do that better if we work together to get there. Thanks everyone. We'll post a recording in a couple of hours as always, and if there's anything we didn't get to, then please do hit me up in chat. Thanks everyone. Talk to you all soon.